Okay, what we're going to do now is we're going to derive the single factor risk model. All right. We're going to do this fairly quickly. There's a couple of important things that we need to understand before we move on about this derivation of the single risk factor. All right. First, let's assume here that we have the returns for an asset I, some asset I, and that those returns are going to be equal to our expectation or our expected returns for that asset plus some error term. So think of this: I might have expectations for a particular stock, what that stock is going to return, but I know I'm going to be wrong. Okay, and so this error term captures my error that comes from my expectation. Does that make sense? So it's important to note that these error terms are distributed with a zero mean. This is what this means. They're distributed with a zero mean and a variance equal to sigma squared epsilon I. Okay, so you can think of in some assets I might understate my expectation. In some assets I might overstate my expectation. But generally speaking, when I when I average across those assets, these error terms have an average of zero. Does that make sense? I've overestimated, I've underestimated, and therefore, on average, the mean is zero. Okay. So this is a pretty straightforward idea. The returns of any asset is just equal to the investor's expectation plus some error term, and those error terms are distributed with a zero mean and a variance of sigma squared when I examine across all assets. All right. Now in equation 2, what we're going to do is we're going to input some risk factor. All right. So think of the world as we know it today. All right. We have expectations for the return on some asset. The actual returns on that asset is going to be equal to our expectations, right? As investors, we can drive the price up or drive the price down based on our expectations. However, what I'm going to do is I'm going to include this risk factor M, all right? You can think of this as the coronavirus sell-off that we're experiencing right now, the global economic shutdown from this pandemic. Suddenly, this model in equation 1, which the returns were entirely driven by my expected return, and certainly I'm wrong here. Now the returns are going to be driven by the expectation of investors plus some level of risk that needs to be identified in the market. Okay, we're still going to be wrong based on our expectations. Okay, and so the error terms are going to be distributed with a zero mean and a variance of sigma squared. And let me also distribute the risk factor with a zero mean and a variance of sigma squared subscript m. Okay, this is going to be important going forward. I'm not going to really explain this right now, but in chapter 9, this will make sense. Okay, so there's some systematic risk factor that we need to input into our model that is driven by our expectations. Okay, a couple of things. First, the variance of each asset I is going to be equal to the variance of the market. Okay, recall from previous discussions, the variance of A plus B is equal to the variance of A plus the variance of B plus 2 times the covariance of A and B. Okay, that's just a statistical property that we talked about previously. So the variance of asset I is going to be equal to the variance of A plus the variance of B plus 2 times the covariance between A and B. Or in the notation that I have, the variance of the risk factor plus the variance of the error term plus 2 times that covariance. Now understand something. The covariance between the risk factor and the errors is zero, right? Again, this is a systematic risk event that I had no idea was going to happen. Suddenly the coronavirus becomes a pandemic. I had no idea that's going to happen. And so the error terms that are associated with my expectations that are wrong were completely uncorrelated with the risk factor. Does that make sense? So the variance of each asset I is simply equal to the variance of the market risk factor, the systematic risk factor, plus the variance of the error term. Okay? Now it's important to note something here. This is interesting. The covariance between, say, some asset I and some asset J, okay, so we're just looking at asset I, but there's a whole bunch of other assets in the economy. The covariance between these two assets, the returns on these two assets, is equal to the covariance of the systematic risk event that is the same for either asset I or asset J, and the error terms of asset I and the error terms of asset J. Now notice something. That the covariance of the error term for asset J and the error term for asset I are going to be uncorrelated with the systematic risk event and are going to be uncorrelated with each other. Okay? So that the covariance between the returns for asset I and the returns for asset J are just going to be equal to the covariance. If you guys understand some statistics, all I'm doing here is the covariance of M and M, the covariance of M and the error term for asset J, the covariance of the error term for asset I and M, and the covariance for the error term of asset I and the error term of asset J. The only thing that matters is the covariance between M and M. And those who've taken a statistics course will know that the covariance between M and M is just equal to the variance of M. So the covariance between asset I and asset J is equal to the variance of the systematic risk event, which is denoted here, which by the way has to be positive because this is a squared term. This suggests that the single factor model generates co-movement. All right? That the covariance between two individual assets is going to be positive. And because it generates co-movement, that harms my optimal portfolio. Recall in previous discussions that I want two assets in my portfolio that have negative covariance. And here what happens is when we account for systematic risk events, systematic risk, that generates co-movement. That's a positive covariance, and that harms my optimal portfolio. Okay. So with an understanding of this, I think this is important to wrap our heads around. Equation 3, what equation 3 is going to say is that, look, asset I and asset J might have different exposure to the systematic risk event M. So let's put in some beta coefficient, some level of exposure that asset I has to asset M. For instance, during the coronavirus crisis that we're experiencing right now, who has more exposure to this crisis, Walmart or Apple, right? Certainly Apple sales are going to be harmed. Walmart, if anybody's been into a Walmart lately, everybody still seems to be going to Walmart and stocking up on things. So the exposure, if asset I equals Walmart, the exposure to the systematic risk event, the coronavirus crisis, is low. If asset I equals Apple, that exposure to the systematic risk event is high. Okay. So in this model, in equation 3 here, the systematic risk can be identified as beta squared times sigma squared subscript m. This is the variance of m. I've got to weight that twice. I've got to square that, right, to get the variance here. That's just a statistical property. And the idiosyncratic risk is just equal to the variance of the epsilon error term here, okay? And notice that the covariance between asset I and asset J is going to be equal to the covariance. Here we're doing the same thing. The exposure of asset I to the systematic risk event plus the error term of asset I. And the covariance of the exposure of asset J to the systematic risk event plus the error term of asset J. Okay. And what we can do here is we can do a little bit of math and we can find, again, because these error terms are uncorrelated with the risk event and the error terms are uncorrelated with each other, the covariance is equal to beta I, the exposure of asset I to the market risk event, the systematic risk event, times beta J, the exposure of asset J to that systematic risk event, times the variance of that risk event. Okay. If the exposure beta, if the exposure to the risk event is positive, then this covariance is positive, and we come up with the same issue that we had before, that the single factor model is going to generate positive co-movement or positive covariance, which is ultimately going to harm our optimal portfolio. Okay, so these are important things to understand. All we're doing is we're putting in a systematic risk event. In the next video, what we're going to do is we're going to talk about how we go about estimating this risk factor. So come back and watch this next one.